The U.S. Securities and Exchange Commission (SEC) plays a critical role in maintaining the integrity, transparency, and fairness of the U.S. financial markets. As the main regulatory body overseeing securities markets, the SEC implements various rules and regulations designed to protect investors, ensure fair market practices, and promote the efficient functioning of capital markets. For U.S. investors, understanding key SEC regulations is vital for navigating the complex world of investments. In this video, we will explore the top 10 SEC regulations that every investor should be familiar with. 1. The Securities Act of 1933. Often referred to as the Truth in Securities Act, the Securities Act of 1933 is one of the cornerstone pieces of legislation governing U.S. financial markets. Its primary purpose is to ensure that investors receive essential information about securities being offered for sale, allowing them to make informed decisions. It mandates that companies must register securities with the SEC before they can offer them to the public, providing transparency and reducing the risk of fraud. The Act also requires the disclosure of financial information and risks associated with the investment. 2. The Securities Exchange Act of 1934. The Securities Exchange Act of 1934 is another pivotal regulation that governs the secondary trading of securities, such as stocks and bonds, on U.S. exchanges. This law established the SEC itself and grants the agency the authority to regulate securities exchanges, brokers, and dealers. A key provision of the Act is the regulation of insider trading, which is prohibited. This law also requires publicly traded companies to file periodic reports, such as 10 kilosecond and 10Qs, to ensure transparency and keep investors informed about their financial health. 3. Rule 10b-5, Anti-Fraud Rule. Rule 10b-5, issued under the Securities Exchange Act of 1934, is one of the most well-known regulations concerning securities fraud. It prohibits any fraudulent activities in connection with the purchase or sale of securities, including insider trading, misrepresentation of material facts, and the dissemination of misleading information. Investors should be aware that trading on material non-public information or engaging in any deceptive practices can result in severe legal consequences, including civil and criminal penalties. 4. Regulation D, Private Offerings. Regulation D provides exemptions from the SEC's registration requirements for certain types of securities offerings. It primarily governs private placements, allowing companies to raise capital from accredited investors without having to go through the lengthy and expensive process of registering securities with the SEC. While this regulation offers relief to businesses, it also provides safeguards to ensure that only sophisticated investors, those with sufficient financial knowledge, participate in such offerings. Investors should understand the different rules within Regulation D, such as Rule 504, Rule 506(b), and Rule 506(c), which dictate the conditions under which securities can be offered. 5. The Investment Company Act of 1940. The Investment Company Act of 1940 regulates companies that engage primarily in the business of investing, reinvesting, and trading in securities. This includes mutual funds, exchange-traded funds, ETFs, and closed-end funds. The Act ensures that these investment vehicles operate in a transparent manner, providing full disclosure to investors regarding fees, risks, and investment strategies. It also sets standards for how funds should be structured and managed, promoting the safety of investor assets. 6. The Sarbanes-Oxley Act of 2002, SOX. The Sarbanes-Oxley Act was enacted in response to major corporate accounting scandals, such as those involving Enron and WorldCom, with the goal of improving the accuracy and reliability of corporate financial reporting. The law established stringent requirements for financial disclosures, internal controls, and auditing practices. For investors, one of the key provisions of SOX is that it holds top executives personally accountable for the accuracy of financial statements, which helps reduce the risk of corporate fraud and increases investor confidence. 7. Dodd-Frank Wall Street Reform and Consumer Protection Act, 2010. The Dodd-Frank Act was implemented after the 2008 financial crisis with the aim of reducing systemic risk in the financial system, improving consumer protections, and enhancing the transparency of financial markets. It introduced several important regulations, such as the Volcker Rule, which restricts proprietary trading by banks, and the creation of the Consumer Financial Protection Bureau, CFPB. For investors, Dodd-Frank also requires publicly traded companies to disclose their executive compensation packages, providing transparency around corporate governance. 8. Regulation FD, Fair Disclosure. Regulation FD, established in 2000, aims to level the playing field in securities markets by ensuring that all investors have equal access to material information. It requires that companies disclose important information, such as earnings reports or significant business developments, simultaneously to the public and to analysts or institutional investors. This regulation helps prevent insider trading and ensures that individual investors have access to the same information as large institutional investors, reducing information asymmetry in the market. 9. The Insider Trading and Securities Fraud Enforcement Act of 1988. The Insider Trading and Securities Fraud Enforcement Act of 1988 bolstered the penalties for insider trading violations and expanded the scope of prohibited practices. The Act allows the SEC to impose both civil and criminal penalties on individuals who engage in insider trading, which includes trading on material non-public information for personal gain. The law also established the tipper-tip liability, meaning that individuals who provide insider information, tippers, can be held liable alongside those who trade on it, tippies. 10. Regulation SP, Privacy of Consumer Financial Information. Regulation SP, implemented under the Gramm-Leach-Bliley Act, governs how financial institutions handle and protect consumer financial information. The regulation mandates that firms take steps to ensure the privacy of their clients' non-public personal information. This includes requirements for privacy policies and procedures, as well as safeguards to prevent unauthorized access to financial data. For investors, this regulation ensures that their financial information remains secure when dealing with brokers, investment firms, and other financial institutions. The SEC regulations outlined above are essential for ensuring transparency, protecting investors, and maintaining the stability and fairness of U.S. financial markets. Whether you are an individual investor, a financial advisor, or a company executive, understanding these rules is crucial for making informed investment decisions and complying with the law. By adhering to these regulations, investors can help foster a more efficient and trustworthy investment environment. Staying informed about SEC regulations is not just a legal requirement but also a strategic approach to managing risks and maximizing the potential for long-term financial success.